Powerful institutions like BlackRock, central banks, and even the UN are quietly reshaping the global retirement system. And if you look closely, you'll notice something unsettling. The model we've been taught to trust is breaking down. What if the pension system isn't a safety net, but a slow-moving crisis? And what if the escape from this crisis has existed for over a decade? And that's why today we'll explore how much Bitcoin you may realistically need to retire, how long it could take to build that stack, and the key risks you must prepare for. My name is Nick, and you're watching The Coin Bureau. First up, I'm not a financial advisor, and nothing in this video should be considered financial advice. It's purely educational content designed to help you understand how Bitcoin could play a role in your long-term financial planning. If that sounds good to you, give that like button a tap, and let's get into it. Now, before we talk about how much Bitcoin you need to retire, we need to talk about why you need it. Because a successful retirement starts with recognizing an uncomfortable truth. The traditional system you've been told to rely on is fundamentally broken. Think about your state or national pension. You pay into it every month, believing that money is being saved for you, quietly compounding until retirement. Sensible, at least in theory. But that is not how it actually works. Your contributions aren't being stored for your future. They're being used immediately to pay today's retirees. And this is called pay-as-you-go or pay-go systems. Each generation funds the generation before it, and that works until it doesn't. When this system began in 1889 under German Chancellor Otto von Bismarck, average life expectancy was around 40 and the retirement age was 70. Pension payments were the exception, not the norm. Today, the opposite is true. Life expectancy in Germany is over 81. Across the developed world, people now draw benefits for 15, 20, sometimes 30 years. In simple terms, the base of the pyramid is shrinking, and the top is living longer than ever. Countries like Spain, Italy, and Japan, all with aging populations and low birth rates, received D and E grades for pension sustainability in the Mercer CFA Institute's 2023 Global Pension Index. The contributor base is collapsing. So, governments face three choices: cut pensions, raise taxes, or quietly debase the currency. Cutting payouts is political suicide. Raising taxes isn't far behind. So they pursue the third option, financial repression. And this means holding interest rates below inflation to erode your purchasing power quietly. An invisible tax used to manage unpayable promises without ever admitting failure. Japan is already there, with public debt over 250% of GDP. Europe and North America are accelerating down the same path. We covered financial repression in a separate video, which you can watch right over here. Now, maybe you're trying to escape this by saving privately, but even then, the numbers simply don't work out. Traditional advice says you should save 12 times your final salary by retirement and withdraw 4% a year. Sounds reasonable. Until you realize the median 401k balance in the United States is roughly $200,000. 4% of that is about $8,000 a year, or around $660 a month. That's not retirement, that's survival, and barely. And even if you save diligently, the stock market growth isn't what it seems. Yes, the S&P 500 keeps hitting new highs, but valuations are being inflated by global liquidity, not productivity. Your portfolio is rising on paper, but your purchasing power is quietly slipping away. Economist Robert Gordon argues that the last 2 centuries of explosive growth were the exception, not the rule, and they were driven by technological breakthroughs that cannot simply be repeated on command. Meanwhile, equity markets are priced for the opposite. The S&P 500 is trading at valuations not seen in years, with investors paying historically high multiples for the same stream of income. The assumption is simple: the future will be richer, more productive, and more profitable, largely thanks to artificial intelligence. But hoping someone will pay even more for those earnings tomorrow isn't investing. It's musical chairs dressed up in a digital utopian narrative. Meanwhile, wage growth isn't keeping up. Average incomes have risen about 1.3% per year, but for the bottom 99%, it's closer to 0.75%, which is of course below inflation. The reality is brutal. The system is designed to keep you working for as long as possible, while quietly eroding whatever you manage to save. Now, if the Fiat retirement system is melting like an ice cube in the sun, the only credible path to financial independence must be built on scarcity and self-sovereignty. And that, of course, brings us to Bitcoin. So the question becomes, how much Bitcoin do you actually need to retire? Well, forget the broken 40-year plan, the 4% withdrawal rule, and the fantasy of living off scraps in your old age. We're aiming much higher, a self-sovereign cash flow that replaces your working income entirely. To understand how this could be possible, we need to borrow a page from the wealth playbook of the 1%. The ultra-rich don't sell their appreciating assets. They don't liquidate their equity, real estate, or fine art to fund their lifestyles. Instead, they leverage them, borrowing against assets and accessing liquidity without triggering capital gains tax. It's a system built around protecting principal, letting it compound, and living off credit against it. And in the coming financial era, Bitcoin is positioned to function in a similar way. It's digital, globally liquid, transparent, and mathematically scarce. Emerging tools both in CeFi and DeFi already allow you to post BTC as collateral and borrow against it. Now, to be absolutely clear, your retirement Bitcoin should remain in self-custody. Third-party risk doesn't disappear just because the brand looks trustworthy, as Celsius and BlockFi brutally proved. For a long-term retirement stack, the conservative play is simple. Hold the asset and only consider collateralization once the system matures and your position is secure. That being said, let's talk numbers. If you accumulate one Bitcoin worth around $100,000 as of late 2025, and Bitcoin continues its historical monetization trajectory, then by early 2030s, collateralizing that Bitcoin at a conservative loan-to-value ratio could potentially generate tens of thousands of dollars in tax-efficient liquidity. In practice, a portion would go to interest reserves, but the model is what matters, not the exact mechanics. And with Bitcoin's fixed supply of 21 million and more than 58 million millionaires globally, mathematically, not even half of them can ever own one Bitcoin, which frames one Bitcoin as a meaningful target for self-sovereign retirement. That said, it's ambitious and understandably out of reach for many, which is why there's a far more attainable milestone, and that still carries a massive significance: 0.1 Bitcoin. Owning 0.1 Bitcoin is not small. In fact, holding that amount places you ahead of roughly 99% of the global population in terms of Bitcoin scarcity. Think of it this way. 0.1 BTC is like owning a small plot of prime digital land before the world fully recognizes its value. Today, that position costs around $10,000, not millions. And as governments print increasingly large amounts of currency to plug pension deficits, even a fractional claim on a fixed supply asset becomes a powerful hedge against systemic debasement. So you don't need to own a whole Bitcoin to secure your future, but having even a fraction puts you ahead of almost everyone else. But if your goal is to accumulate Bitcoin efficiently, then be sure to check out the Coin Bureau Deals page. That's where you'll find exclusive sign-up bonuses of up to $100,000, plus trading fee discounts of up to 50%. And cashbacks on deposits of 75% on the best crypto exchanges around. Just hit the link in the description or scan this QR code on your screen. Once you're over there, browse all the partner offers and click one of the Sign Up Now buttons to claim your deal. Now, these offers won't be around forever, so grab them while you still can using the link down below or scanning the QR code. Back to the video. Next, let's pivot that mindset to action, because whether you're aiming for the 0.1 BTC foundation or the full 1 BTC milestone, the key is the same: accumulation. The traditional 30 or 40-year savings path simply won't cut it anymore, not in the economic world we're walking into. The fiat system is engineered to keep you contributing for decades, promising comfort later while quietly eroding your purchasing power in the background. Yet the reality is far from reassuring. The average investor earns roughly 4% a year, not the fantasy 8% figure that you see in textbooks. At those returns, the safe withdrawal rate isn't 4%, it's closer to 2%. And suddenly, a retirement income of $50,000 a year requires nearly $2.5 million in assets. A 20-year-old would need to invest around $1,500 every single month for decades to hit that number. Most people cannot and do not do that, and so they end up working longer, retiring later, and ultimately relying on a system that no longer works as intended. Bitcoin flips that paradigm. The so-called cheat code here isn't reckless risk-taking. It's focused conviction and a compressed time horizon. Instead of spreading thin across dozens of assets just in case, you allocate strategically into a single, provably scarce asset with asymmetric upside. And the irony? The wealthy have always done this. Most of the world's wealthiest individuals concentrate the majority of their net worth in one primary asset or business. Zuckerberg didn't diversify to escape risk, he concentrated into Meta, and Bezos into Amazon. The idea that diversification alone builds wealth is a myth pushed to those who don't have enough capital to concentrate in the first place. For Bitcoin, the approach is straightforward: accumulate consistently. If you have capital available in the long term, a lump sum allocation may make sense. If not, dollar cost averaging month after month through market highs, lows, and sideways action removes emotion and steadily builds your position. You're not trying to time perfection, you're positioning for inevitability. And this works because Bitcoin operates in a monetary system fundamentally different from the one you earn in today. Fiat is designed to depreciate. Gold offers a partial solution, but it isn't perfectly scarce and isn't native for a digital economy. Bitcoin fixed both limitations. It is mathematically capped at 21 million coins and globally accessible without permission. We're also entering a new market regime. Aging demographics, record debt levels, and geopolitical fragmentation are putting pressure on traditional portfolio models. The era of effortless equity appreciation may be fading. Meanwhile, baby boomer outflows from retirement accounts are already beginning, shifting markets from decades of inflows to structural selling pressure. So instead of a slow glide path to retirement in your 60s, this decade presents a rare window to build financial independence far faster if you take self-custody seriously and recognize that personal sovereignty requires personal responsibility. Because with Bitcoin, there is no bank manager, no fund custodian, and no government safety net. You must become your own bank. Now, securing your Bitcoin isn't just about accumulating, it's about defending your sovereignty. Because while you're stacking sats, some of the most powerful institutions on earth are quietly moving to make sure you never truly own financial freedom. And this battle is happening on two fronts: political control and financial capture. Let's start with politics. BlackRock's CEO Larry Fink and the global policy elite have made no secret of their ambition, funneling trillions of dollars of private savings into massive infrastructure projects to fund the UN's Sustainable Development Goals. BlackRock estimates this agenda needs around $68 trillion, and the money has to come from somewhere. Their eyes are on the tens of trillions of dollars sitting in passive savings across the US and the EU. And in Europe, the mechanism to channel that capital is already being built: the Savings and Investment Union. Its architect has openly confirmed the plan includes mandatory auto-enrollment into EU-managed pension schemes. In simple terms, this means your savings could be gradually redirected into politically approved ESG projects, from green infrastructure to digital identity systems, whether you like it or not. It's central planning dressed up as a public good. Financial choice quietly replaced with obligation. But while governments centralize savings, Wall Street is attempting to centralize Bitcoin itself. Right now, a tug of war is unfolding over the network's future. On the one side are the incumbents, BlackRock, Fidelity, and Vanguard. And these firms now hold major stakes in the leading US Bitcoin miners, giving them influence over roughly 1/3 of Bitcoin's hash rate. And as we've seen in traditional finance, where they go, dystopian policies tend to follow. They're also creeping into development. Bitwise and VanEck have already begun donating ETF proceeds to Bitcoin core developers, a precedent that opens the door for trillion-dollar institutions to shape protocol decisions over time. Yet the most potent form of control is hidden in the paperwork. BlackRock's spot Bitcoin ETF filing gives the firm sole discretion to choose which chain it will support in the event of a hard fork, including a future quantum resistant upgrade, which most analysts view as inevitable. With IBIT alone holding tens of billions in Bitcoin, and the largest issuers now controlling around 85% of crypto fund AUM, that influence could define which chain becomes the real Bitcoin in the eyes of the markets. Imagine a fork where one version stays a proof of work and another shifts to a regulator-friendly proof of stake. Many institutional holders and retail followers would simply go where the liquidity is. And we covered this topic in much more detail in a video you can watch right over here. Fortunately, Bitcoin isn't without its defenders. On the other end of the rope, Tether is positioning itself as the anti-establishment counterweight. CEO Paulo Arduino has pledged to fund Bitcoin development in the name of decentralization, and Tether has invested hundreds of millions of dollars into mining, quietly becoming one of the largest contributors to the hash rate. So, ironically, Bitcoin's decentralization isn't a result of nobody trying to control it. It's because powerful forces are competing, creating a sort of balance. But make no mistake, if either side stumbles, whether through a change in interest rate dynamics or a crisis of trust in custodians, that balance could collapse, and whichever side remains would have the leverage to shape Bitcoin's future. Okay, after everything we've covered, there's one last threat to your long-term Bitcoin wealth, and it sits beyond governments, banks, and regulation. It's not political or financial, it's physical. Because while BlackRock, politicians, and central banks may try to control Bitcoin, they cannot outwit the laws of physics. And the one they can't escape is the rise of quantum computing. For anyone unfamiliar, quantum computers don't process data the way your laptop does. They use qubits, which are particles that can exist in multiple states at once, to perform calculations exponentially faster than any traditional classical computer could ever do. And progress in this field has been moving faster than almost anyone expected. Researchers are already experimenting with prototype systems that hint at capabilities once thought decades away. The current estimate is that around 8,000 logical qubits would be enough to break Bitcoin's SHA-256 encryption, the algorithm that secures the network. We're not there yet, but history has a pattern. Breakthroughs seem impossible right up until the moment they're inevitable. And the question isn't if that threshold will be reached, it's when. And when it is, Bitcoin could face its most serious challenge yet. Even if developers successfully migrate to a quantum-resistant standard, around 3.7 million BTC are believed to be permanently lost in old wallets that can't be updated. And those coins are dormant today, but to a quantum computer, they'd be a buffet of unclaimed digital gold. And if that supply ever hit the market all at once, the price would collapse and confidence would evaporate overnight. The community would be forced into a brutal decision: do nothing and watch the third of the supply vanish into a hacker's hands, or execute a hard fork to reclaim or destroy those coins, effectively rewriting the rules of Bitcoin itself. While that threat sits somewhere on the horizon, there's a far more immediate one: human failure and custodial risk. Most Bitcoin isn't lost to quantum computers, it's lost to counterparty promises, which is why self-custody isn't optional. It's the only thing that turns Bitcoin from speculation into sovereignty. Leaving your Bitcoin on an exchange invites every risk the traditional system already suffers from. We've seen it all before: FTX, Celsius, BlockFi. The names change, but the lesson stays the same. So, the first step in your long-term plan is simple. Move your Bitcoin off exchanges and onto a secure hardware wallet, one that never touches the internet. Think of it as your personal vault, the foundation of your financial sovereignty. The second step is legacy, because freedom doesn't end with you, it continues through those who come after. If your heirs can't access your keys, your Bitcoin is gone forever. So build a plan. multi-signature access, encrypted backups, or professional estate solutions designed for digital assets. True sovereignty means thinking in generations, not just in years. The fiat system asks you to trust the state for 40 years. Bitcoin asks you to trust yourself, to protect your wealth, your privacy, and your family's future. So take your time, plan carefully, and stay humble. And, as always, touch some grass and keep stacking those sats. Not financial advice, of course. Okay, if Bitcoin still feels a little bit abstract and you want it explained in plain English, we've covered the fundamentals in detail right over here. And if you haven't subscribed to the channel yet, you can do that right over here. Thank you very much for watching, and I'll see you guys again soon. This is Nick, signing off.